What's going on, guys? This is your host, Ian Starkey of the New Equity Connections podcast. Today, I'm sitting down with a good friend of mine, Jennings. Losing my voice a little bit. Jennings is partnered with Yeadon Smith. So, Yeadon, I'm sure you saw on a previous episode, I sat down with Yeadon. Incredible guy. Jennings is another great man and operator. He just closed on another property that puts him at, in the total portfolio, around 940 doors. So they own several different apartment complexes. In total, that's 940 units, 940 people that he is the landlord for. He also just bought a super cool car that I'm really obsessed with. Got himself a Ferrari. And the most important thing is he's an incredible guy, an incredible father to a beautiful family. So Jennings, I really appreciate you taking the time to hop on the show. Welcome.
Thanks, Ian. Man, I appreciate you having me on here. And it was cool to see you in Charleston a few months ago at Tim's event. So yeah, man, it's been a wild ride for the last couple of years.
Mm-hmm. And when did you guys get started in your multifamily investing journey? Let's look at that real quick.
So I started with a few trailers about 7 or 8 years ago. I bought a $5,000 mobile home, fixed it up, and I sold it owner financed. That was kind of like my first foray into being a landlord. And it didn't work out. The guy stopped paying me and I had to evict him and take it back and redo it. And he had trashed it. And I almost was like, wow, this doesn't work, and gave up. But really the problem was I hadn't done my homework on how to place good people in properties. I just didn't know what I was doing. And so I didn't quit, and I bought a few more mobile homes with much more success. And then I got my first rental house, and I got my second rental house. And I had kind of been following my parents' example or my dad's example. And I see that a lot where, you kind of rise to the level of your own environment. Like you want to be at least as successful as your parents, maybe a little bit more, but that can be a pretty powerful ceiling of the strata of the social status that you're in. And so I was just like, well, this is how he did it. But I realized, this is really slow. And I had written down a goal of 1,000 doors, which I'm almost at, funnily enough. But I had written that down, and I did the math and I did the timeline on how I was going to get there. And it was just insane. Like it was going to take forever. And not only that, the logistics of trying to buy 20 or 30 rental houses a month, it just, once you were scaling, it just didn't really seem feasible. And I just was very puzzled on how people really did this and made significant money because, I owned a few trailers and a few rentals and I'm making, a few $100s a month in cash flow, but nothing significant that was going to really change my life. So yeah, I bought a course online, just like a little simple education course. It was $1,000. And it showed you how to buy multifamily. And I thought, okay, multifamily, probably the way to go here in trailer parks, whatever. And I bought that and I really just sat on it for about 2 years. I just kind of studied it, but didn't ever pull the trigger, didn't have the time, didn't have the effort, couldn't find a deal, whatever. I just really wasn't focusing on it. But I always kind of kept coming back to wanting to do it. And one day I was just poking around online and I found a 12 unit for sale for like $250,000. And I thought, man, that's got to be a pretty good deal. It was in the middle of nowhere. It was a little town in North Carolina, about 5 hours from me. But I drove up there and it was, it was a solid property. It was in better shape than I thought. And the seller was willing to owner finance it because he was losing money. He was not running it well. He was an older guy and he had a lot of good properties and he didn't really care about this property too much. So he was willing to owner finance it with 30% down. And that was great because I didn't have probably the ability to get that loan necessarily at the time. And so I put together a little pitch from the course I had bought on, hey, I'm going to give you, Mr. Investor, 40% of this deal. I'm going to, you're going to make this much money. I think we're going to refinance it in a couple of years. You're going to get your money back and it's going to be awesome. And I'll do all the work. And I actually presented it to my dad. And he was intrigued because he was going to be able to make more money doing this than he was with rental homes. And he wasn't going to have to do any work or take on any debt or really have anything to do with it other than give me the $96,000 I needed for the down payment. Mm-hmm. But he still did kind of push back on me. He was like, hey, why do you get 60% and I get 40%? Mm-hmm. And he's no fool. I mean, he's not an idiot. He would not invest in something that he didn't think was sound. Mm-hmm. And so I kind of pushed back and said, well, Dad, this is a great deal and money is everywhere. Deals are very difficult to find. There's a lot of people that want to invest in real estate. This is a great deal for you. If you want it, great. If you don't want it, then with all due respect, I'll find somebody that does. And I was kind of bluffing a little bit because I really was hoping that he would go for the deal.
Yeah.
And he did. He went for the deal. So we bought the deal and I found a good management company, did a few little things here and there, tweaked it, turned it up, and ended up selling it about 18 months later for $410,000 and turning a great profit. He got all his money back. He made, I don't know, 50% both years, IRR on his money, and I made good money too. So that was kind of like my first foray into syndicating. And then I just kind of kept going from there. I went to Tim's conference, learned about the Burr model there, and met some people that ended up being my loan sponsors on a few future deals. And we really got that momentum building.
That's awesome. And after, so it was a 12 unit, then Tim's conference. And then from there, just the rocket took off, seems like.
Yeah. I was watching a Facebook live stream or something. I don't know. Tim was walking through one of his properties in Georgia that he had bought. And then he was talking about how he had bought it for $30,000 a door and he was going to do this and that, and they were going to refinance it. And I just was thinking, man, that's what I want to do. That resonated with me very much so. And so, I convinced Yeadon to split the cost with me because it was $5,000 to go to the conference, plus flights and everything else. So we went up there and, as we were leaving, we had been looking at a 63 unit in Goose Creek, which is a town by Charleston. Mm-hmm. And under the other model, it did not work. There wasn't enough value add there. But under a heavy rehab Burr, where we could really significantly raise rents, it did work. And I was like, wow, this is amazing. I got more knowledge. I got more ideas on how to do this perspectives. And I was able to close the deal. And I think that a lot of people that are struggling in multifamily, they look at things through one lens, where they're looking at a deal through this specific model and it doesn't work. And so they throw it away and they throw it away and they throw it away. And then they complain that there's no deals to be had, when really they just don't know how to creatively look at the deal. Are you able to flip it, value add it? Maybe there's not enough meat on the bone to refinance everybody out, but can you just sell it in 2 years or 3 years? Can you do a traditional syndication where you give away most of the equity and it's a 5 to 7 year horizon and you can do a partial refinance after 3 or 4 years? Can you do seller financing where the seller is financing a lot of it and you don't need as much down payment, so the returns don't have to be as good because there's not as much investor money going into the deal? Can you do a seller carryback where you're getting a traditional loan and the seller is loaning you the down payment, so there are no investors, so the IRR really doesn't matter at that point? You just have to be able to get the seller back out in a couple of years, whatever you negotiate. And so when people start looking at different models, the scales kind of fall off and there are deals out there. And so Yeadon and I built a whole course around this and how the different models can work and how you can make a deal where there may not seem to be a deal. And so once I sort of started unlocking multiple models of doing multifamily, it became a lot easier to close deals. And that's how we grew to almost 1,000 doors in 2 years, from having a couple trailers and 2 rental houses.
Mm-hmm. Yeah. And that's one thing that, that I've kind of explored, because I kind of have a relatively similar course to you. That's how Jennings and I met. For those who don't know of Tim Bratz, he is an absolute stud. He's based out of Cleveland. And I joined his course. I think I joined in 2019. Or I joined in 2020. It was an online course for me, and then from that course, we joined the mastermind. That's where Jennings and I met. But yeah, his model is very different from a traditional model of syndication, which it's not a bad model. Some would say it's a better, some would say it's worse. But to your point, there's a lot of ways to skin a cat. I mean, there's, buying a D class apartment that's completely vacant. There's ways to make money there. There's ways to buy a fully stabilized A class asset and make money there. So it's kind of, and I guess through your growth and acquiring all those doors and all those properties, have you guys have used multiple models, right? Or have you stuck to one for each one?
No, we've used multiple models. I would say the only one we haven't really done is the traditional syndicate. Well, yeah, we have done it. We did a 200. So I'm a GP on a 240 unit in Winston-Salem with Hemel Badiani. I don't know if you know him, Exponential Equity, but
I've heard of him.
I don't count that in my door count because we just raised a little bit of capital and got a very small slice of that deal. But that was a traditionally syndicated deal that it really didn't kind of fit that we could refinance it in a year or two and get everybody the money back. But it was still a phenomenal deal in a great market. And so we kind of sold it on a traditional syndication. 70% went to the investors, 30% went to the general partners. But after a 15% IRR hurdle, then the split dropped to 50-50 between GP and LP. And so kind of a unique setup. And it's turning out that the deal is so good, the rents are getting there that they're going to be able to refinance the whole thing out in like a year. So it did end up fitting the Burr model, but it didn't have enough cash flow to pay a real high preferred return. So that's why we did more of a split to the investors. But yeah, I've used that model. I try to go with 25 to 30% to the investors, 70% to the GP with a heavy pref, 9-10% preferred return and all the money back in 2 years or less. I try to go that model if I can, just because that's the way you get the most equity as a general partner. If I can't do that though, then I'll look at it. Well, what does it look like on the IRR for the investors if we sell it in 2 years? So we've got a deal up in Moline, Illinois. It's 115 doors. We got it for like $33,000 a door, and the gross rents were $55,000 a month at closing. And so if you're familiar with real estate, that something that you're buying for $33,000 a door, that you're all in for like $4 million, that's cash flowing 55, or not cash flowing, but gross rents at $55K a month. That's a good deal. I mean, there's a lot of meat on the bone there.
Yeah.
But it's in Illinois. That's not a super great market long term. The taxes are very high. Moline is it's part of the Quad Cities. There's a decent sized population there, but it's not a property that I really want to hold for 10 years,
Yeah.
And so the cap rates there are a little higher. And so the refinance out model didn't quite work, but I could still make money with this deal. I mean, I could still make $1.5 to $1.8 million in 2 years just by raising rents $100 and doing a, $900K renovation. And so I'm like, I don't want to throw away that opportunity. And it's a really safe deal. It was 85% occupied. And I think our mortgage on that thing is like, $15,000 to $18,000 a month, and it's bringing in $55,000 at closing. So it's a pretty safe deal. So we went for it. We bought that property, and with telling the investors, hey, we're going to pay you a 10% pref, and we're going to sell it in 2 years, and then you're going to get 30% of the profit. And so their IRR was like 26, 27%, or projected when we sell it. Hopefully that's what they'll hit. But that, if I had been strictly looking at it as, can I burr this and cash flow it in for 10 years, then I would have thrown that deal away. And I wouldn't have closed another 115 units, and I wouldn't have made the money that we hopefully are going to make on that deal. And it's working well. We kind of went outside of our box as far as buying in the North like that, but at the right cost basis, it made sense. And now we had some issues with getting workers and getting the stuff done. but we've got that rolling now. We got a phenomenal management company, and the property is starting to turn around and make the push. So once we get the rent roll up to like 80,000, then we'll sell it. Just a simple deal.
Yeah, so that's when you're looking as a flip. I mean, you're just looking to take down doors right now, right? You're not really, like you said, you're not stuck to one model. You're just, okay, look at it this way, look at it that way. Does it work this way? Does it work that way? If it works that way, we'll take it down. If it does, I mean, what's a deal you're actually going to kill, I guess, is a good question.
So
like what's something, yeah.
Yeah, I would say I'm not trying to just take down doors. Because I set this challenge, 1,000 unit challenge last year, and I was trying to close 1,000 units by the end of 2020. And I didn't hit it. I think we got to like 600 or 650. I mean, we got close, sort of close, but not really. And I was just thinking about that in retrospect, was like, was that really the best idea to set this goal of a number and push myself to maybe make a bad deal on something that really, it's just the risk is too high. You don't want to be chasing a number. You want to just only do good deals. And so, there are a lot of deals that I will kill. Like if it's in a shrinking, declining market, I pretty much am going to kill that deal. Really heavily distressed deals, most of the time, I will not go for them. Somebody pitched me on a deal that, it was, you see these sometimes where it's like it's 100% vacant or 90% vacant. It's in Memphis, but it's $10,000 or $15,000 a door, and you're like, oh, I could make so much money. No, not really. You're
no,
not when you're getting people murdered on your property every week, and people ripping the wiring out of your buildings. You can't get contractors. You got to hire full-time police officers to be there. I mean, it's like, I don't want that. So I definitely am staying away from the really distressed stuff, unless it's in a phenomenal area. Like the 91 unit was pretty distressed. It was 50% vacant, but it was in Statesboro, Georgia, which has had like a 50% growth over the last 20 years. So I like that market. It's growing. I already have a 80 unit in Statesboro, so I know that it's a good market. And so that's something I'm going to take on, something that has a little bit more risk. But I guess if it's in a good market and it's at a decent price per door, like our wheelhouse is 30,000 to 70,000 a door. If it's kind of in that, I'm going to try and make that deal work. If I can do a flip and make it work, then I'll buy that. If I can do the Burr model, I'm definitely going to buy that. If I can do pay a little bit more but get seller financing, then I'm going to do that. As long as it's in a good deal where I can amortize debt and I can give my investors a really solid return. And I think that's the biggest thing, Ian, is having the reputation of putting phenomenal deals in front of your investors time and time again, and not you put one crap deal in front of them, they're really going to lose faith. I think like they're going to be like, wait a minute. I thought this guy knew what he was doing. This is terrible. There's going to be people that don't like your deal for whatever reason, but there's some deals that I look at that are being syndicated and it's just like, whoa, that is not a great deal. But they somehow they raise the money and they close them. Some of them do, but I don't want to put deals like that in front of my investors. So that's where I would say I would kill the deal if it's too risky, if it's in a declining or shrinking market, or if I just can't get, above 20% IRR for my investors, then I'm probably not going to pursue that one unless I can do the owner financing. And that's what have you done anything with owner financing on any of your deals?
So I haven't closed on anything yet, but we have this day and time, we have an RV park in Austin under contract where the park right now, it's 20 acres of land with about 12 or 13 pads. Just kind of scattered about. The owner's got like 10 different projects going on that he just picks up, puts down. He's like, oh, let me do this now. Let me do that. So with that deal, the way we structured the purchase of the land, the purchase of the current park is 30% owner carryback, and then we'll get 70% from the bank. So, the land, it's like 1.2 mil. It's a steal. For Austin, it's a steal. So that's nice, but we are going to have to raise probably around 1 million or 2 for the capex. But yeah, no, that's one I'm working on now. Is where we don't have to come out of pocket anything for this land, and we got I think it's a 15-year note, 5% interest a year. So this guy, I mean, he's older. His wife wants to travel. So he's going to get a big check at closing, have a very low tax liability because he's not realizing all his capital gains that first year, and then he's going to make 5% a year on like 300 grand. So I mean, he's not making a butt ton of money now, so that's a really good deal for him. And we can refi, we can cash him out at any point. So yeah, that's what I'm working on now, but haven't closed on anything like that yet.
Well, that's a phenomenal deal, and I want to bring that up for your listeners because I feel like a lot of people are not thinking about that option, and because that option almost makes any deal work if you think within reason. And I say this stuff with a grain of salt because I feel like it's kind of dangerous information if you don't really fully understand it. But you can take this kernel that you're hearing on the show, from Ian and the way he's doing his RV park, and for me, some of the apartment complexes we bought, and you can educate yourself further on this. But if you think about it, the biggest constraint to any deal is the cost of your capital. Like, what are the investors going to get? What's their return, and how are they going to get their money back? And when you take that variable out of the deal by negotiating a 30% seller carryback, then 5% IRR is all that seller is wanting, right? 5% interest only, and he wants the money back in a certain set of years, and you're going to do a value add and be able to either sell it or refinance it. And you can walk into that deal with no money down, with no investors, giving away no equity. And yeah, you took on a debt from the bank, but you can even negotiate the renovation costs into that bank loan in certain instances. I don't know if that was possible in your RV deal, but like the best deal, the most equity, the most money I've made by far was it was like 76 units in Monk's Corner, which is a town outside of our town. Very distressed, but we know it's a good area. We already owned in that area. Yeadon stumbled upon it. It's like half boarded up. The rent roll was $22,000 and it should have been, $60,000. And we called this lady and asked her if she's interested in selling. And she said, yeah, I would be interested. I'm actually had a deal fall through and I want to sell it. And so we say, okay, well, what do you want? She's like, I want 2.5 million for it. And it's just not worth it. It is worth that, but it's not worth that in the condition it's in. I mean, these buildings were never finished. Like, no COs were ever issued, like majorly distressed.
Yeah.
And so we look at it and we crunch the numbers, kind of like just a straight up buy. And we tell the lady, listen, we can only pay you $1.5 million for this property, just straight up. However, if you will loan us $1 million, we can pay you 2.4 million. We can almost pay you your full asking price, but you got to loan us back, $1 million for our down payment to help us get this renovation going. And she said, she thought it over with her family. It's like, okay, either get 1.5 million and nothing, or I get 1.4 million at closing, and then I get another million in a few years, and they're making payments, just like you structured it. So she went for it. After vetting us and making sure that she felt comfortable with the risk, because she didn't have a mortgage. She wasn't really in a strong position to foreclose or do anything if we didn't pay her. So she really had to trust us. So we then went to a bank and said, okay, we want to buy this property for 2.4 million. We need $1 million renovation. And they loaned us 80% of the renovation and 80% of the purchase price because it's in the Charleston market. And so, long story short, we got all the money to buy it. We got all the money to renovate it. We got the seller carryback from the lady, and there was a surplus of $200,000 to pay a little bit of an acquisition fee and to get the renovation kicked off and just have extra money in the bank. And so, and we owned 100% of it. Like myself, Yeadon, and our partners in Maine that are our loan sponsors that helped us get the loan, and they're really great guys that we like to partner with. But we each got a massive chunk of that deal. So that one deal is almost 1/3 of the net worth that I've built through all my 940 doors, because there were no investors and there was nothing given away. And so that's where I want to encourage your audience to think about. If your seller wants $1 million for a property and you really can only pay 800,000 to make your numbers work, you can make 2 offers. You can say, here's my cash offer, but I can get you your number. You just have to loan me 300,000. I'll give you 700,000 at closing, and I'll give you the other 300,000 in 5 years or 3 years. I'll make payments, and then we'll sell it or refinance it. That way you can amortize debt, you can build your balance sheet, you can build your wealth, and and make a deal happen, versus, I didn't get it for 65 cents on the dollar, so I'm gonna have to pass. Okay, like, don't try to kill the deal. If it's in a good market, try to make the deal work, is my kind of mindset with what we did.
Oh yeah, dude, that's awesome. And to that point, man, having to buy at a certain buy box, having to buy for 65% of the value, it's that number, it's really hard to justify in this market, dude. I mean, we're seeing in Texas 10, 12, 15% rent increases. I mean, and that's happened this year, that's projected to happen next year. So what you're thinking is 65% of the value, could be 55%, could be 45%. I mean, people are not going to give their property away. So getting creative and buying for the right price, you can even buy at market value and make money, dude. It's really a unique time in multifamily.
Yeah, I mean, my caution with the seller financing, because you're basically 100% financing, is it can be safer because you're not paying a big preferred return to your investors. But I like to make sure that the deal will pretty much cover the cost of the first mortgage to the bank and your seller note, your expenses. And it really doesn't have to cash flow too much beyond that, because there's no pref or anything. But if you can cover that, and then you have an opportunity to make the property better by, turning it over, rent raises, whatever you're going to do, then you've got a deal on your hands. And it's pretty easy to make a deal work when all you have to do is break even, and you don't have to pay hit 18% IRR to your investor, right?
Yeah.
So it opens up a lot more doors, and that's why that's one of the major anchors of our course, is how to do that, how to structure it, the legal documents, how to pitch the seller on that, how to convince them to go for that, how to secure that note with them so that they feel comfortable loaning you the money, and how to do the transactional funding at closing so that you don't get jammed up and the seller at the last minute is like, you know what, I got all my money and I don't want to do that loan. Now you're screwed. Like, how do you navigate that? So that's why I tell people this information can be dangerous. So make sure you know what you're doing with it.
Absolutely. And I guess I want to take it back to that story. So you agreed for two, you said 2.4 million. And you also agreed to have them finance back $1 million, and you got a loan from the bank as well. So how did that actually shake up at the table? Because a lot of banks don't want to have a second lien position, especially if they're doing money for purchase and renovations. So what did that really look like when it got down to, signing and doing the deal?
So it just depends on the bank. You can there are banks that will agree to it or don't care. They'll kind of say, I've had banks say, we don't care where you get the down payment as long as you got the down payment. And there's other banks that are like, no, we don't really want that, and we're not going to allow a second mortgage. And so you have to think of it like, okay, I am allowed to borrow money from whoever I want to borrow money from, right? So if I close this deal, then, and I bring the cash for the down payment and the bank brings the balance, we close the transaction. Then if the seller wants to loan me, whatever, $1 million, 300,000, whatever it is, in an unrelated transaction that is not secured by the property, how does that increase the risk profile to the bank.
It doesn't.
It doesn't. There's no further debt on it. I mean, the bank's fine with you raising the money from investors and paying them a 10% preferred return. It's essentially like your seller is becoming your sole investor. And the terms you've worked out with your investor is 5%, interest only. We're going to get you back out in 3 years, but we have an option to extend for 2 years. And I'm going to personally guarantee the note if you want to. I mean, I have personally guaranteed these notes so that, if something goes awry, they can come after all my properties, including the subject property, but not in the same way that they have like a second position mortgage on it. But then again, some banks don't care if you have a second mortgage on it either. So it just sort of depends on the bank. I mean, the best policy is find a bank that is on board with it. Second is, do it in a separate transaction post-closing between you and the seller as a personal, loan. And you got to disclose that to the bank on your balance sheet that you're holding a loan for $400,000, when you're applying for this. Like you got to be careful. And that's why I don't really like talking about the mechanics of this too much just publicly, because you can get jammed up with this kind of stuff if you don't do it right. And don't disclose certain things.
But dude, for everyone watching this video, if you do not understand what he talked about, seriously, pause and rewind all that. As many times as it takes, because that information right there can make you millions upon millions of real estate. Seriously. Dude, you're giving out so much free game right now. If you don't, you got to buy his course. I'm going to put the link in the description. Seriously. But there's a lot of nuts and bolts to it, man. But you're hitting you're explaining it so well, and it makes sense. As long as you don't over leverage yourself or put yourself in a rough situation where, you are going to be cash flow negative with the note and with the bank loan, it's a great way to take down deals.
Yeah. It's big boy stuff. Like you have to realize, yes, I underwrote this deal properly. Yes, I allocated my expenses correctly. Yes, in 3 years, I'm going to be able to refinance and get this seller out, or I'm going to be able to extend it, or I'm going to be able to sell it, or whatever you have for your exit strategy. Like you have to understand what you're doing, because the leverage can cut both ways, where you're missing those payments. The seller is not going to just forget about it. They're going to start coming after you, all your portfolio, everything, because it's going to be really difficult to convince someone to loan you this money without securing it by the property, without your personal guarantee, or securing it with any other assets. Like that's going to be probably impossible. And so if you don't know what you're doing, you could theoretically lose everything. Not everything, but a lot. It's bad. You have to know what you're doing with this tool, but it can be very powerful.
Oh yeah. So are you doing, I guess, with the seller, with the agreement you're signing with them, is it a personal guarantee with the seller as well, or just the bank?
No, it's a personal guarantee with the seller.
Oh, okay. All right.
So I'm saying you don't have to do it that way, but that's the way I have done it. I've bought a couple properties this way, and like, for example, we bought a self-storage place for $1.2 million. I felt like it was only worth about $900,000 if I was just going to buy it straight up. Mm-hmm. But I liked it. It was nearby me. And I got to know the seller. He liked me, he trusted me. And I said, well, listen, if you loan me $300,000, I can give you $900,000 at closing. And we can make this deal work at 1.2, which is what you want. But you got to loan me $300K personally. And he was good. He was good with that. So I said, it was just a prom note with a personal guarantee for $300K. I'm paying him interest only every month. And I think I have 3 years with a 2-year extension. And at the last minute, he renegotiated and didn't want the 2-year extension. Mm-hmm. And so to make the deal work, I agreed to that. And so worst case scenario, in 3 years, if I don't have the rents where they need to be, and I don't have the property where it needs to be able to refinance it, then I'll just have to sell that property. Mm-hmm. And get them out. And I'll still make, I can't imagine not being able to sell that property for 1.6, 1.7. So I can still make $300,000, $400,000, $500,000 even if I have to sell it.
Mm-hmm.
So.
Okay. Dude, dropping so much value. This is one of the best podcasts I've had as far as straight value and just free knowledge, man. Thank you so much. So let me ask you this. So you've had a lot of success in a short amount of time. What does Jennings see in 5 years for him? What's the next 5 years? 5 years from now, I mean, what's that going to look like? Where do you want to be in 5?
So my goal is to keep closing deals. I want to keep closing good deals, but I really am not of the mindset that I want to eat the world with the real estate. Like, I'm not trying to close, a couple thousand doors a year. I want to close 3 or 4 good deals a year. And as opportunities come to me, then we take them down. There's people in my mentoring group. I have a Facebook group that is free. We got all these videos and information in there. My first million in multifamily. And then we have a paid group, the Deal Room, which is more of a mentoring group. And I didn't want to build that group as, well, I'm the bottleneck. Like, if you want to do deals, you got to come through me, and I'll tell you if I like them or not. And if I like them, then I'll partner with you. That does happen organically. I'm not saying it doesn't happen, but the point is to teach the person to fish versus holding all the fish and just picking and choosing, because that's very frustrating for people to have a gatekeeper like that. I want them to be able to push as hard as they want. And so what I've done with the Deal Room is planted like people that have, sponsored loans over $1 million get free access to my group. People that have, invested personally $500,000 or more into syndications, I plant them into our group. If they have raised over $1 million of capital, I plant them in the group. And so these people are in the group with the up and comers, the operators that are out there finding deals and raising money. And now I'm not trying to get all the deals for myself. I'm trying to get as many people like myself in the Deal Room to make that room as valuable as possible. And that's sort of my thought with the education is, don't build a system where you're the gatekeeper. Build a system where you're teaching and creating a community of everybody has money. Everybody has ability to raise capital. There's more than one loan sponsor in there in case you may have a good deal and maybe I just put something under contract last week, and so I don't have the appetite for it. Or you have a good deal, but it's in Massachusetts, and I don't really want to buy in Massachusetts. I want to buy in Georgia. Doesn't mean it's a bad deal. But if I've got a sponsor planted in my Deal Room out of Massachusetts, he's probably going to be interested in that deal. And so that's sort of my thing is pick out a couple deals a year, continue to build my portfolio. But I have a passion for teaching people, being a connector, helping people to close deals on their own, build financial freedom. I mean, that's really fun for me, versus just, taking on thousands and thousands of doors, because it does get to be a grind. Like, I don't care how well organized you are. You have 5,000-10,000 doors, like that is a full-time job. And I'm kind of like, I'd rather give away more equity. Like this last deal I closed, I only got, I think 11% of that deal, because at the last minute, we took on one more partner, gave them a piece of equity to take over our operational role for us, so that Yeadon and I didn't have to do it. Because every deal you do, you take on more responsibility. And in the beginning, you're good with that, but eventually you stop. Like, you realize there's got to be an end to that. It's not scalable.
Yeah, I mean, it comes down to your time. Once you have the money you need, you can keep making more, but we all got in this space for financial freedom and freedom of time, which really comes down to having freedom of time and be able to do what you want when you want. So yeah, I was going to say something.
Dude, you're totally right. You're totally right. If you're making $40,000 a month and you can make $50,000 a month, you want to, but you don't want to give up anything to do it. You see what I'm saying? Like Fridays, I have blocked off as my day. I don't have to do anything on Friday. I don't want to do. And I'm trying to get, I wanted to do this,
Yeah.
So, And I'm trying to get more of that in my life. Like we always are driven. We're always going to want to accomplish things, but carving it out and building the life, like you're the architect of the life, and not chasing the money, but chasing, I want to have these experiences with my kids. I want to go on vacation. I want to be able to go out on my little pond in my backyard with my kid, paddle around the canoe and catch a bass. Like I don't want to be like constantly barraged by, oh, I got to raise $10 million over the next 30 days to close this 500 unit portfolio. Like it just doesn't super interest me to go down that road. Like I want to make money. I want to make a lot of money, but I want to do it on my terms. And so if I take a little less equity, I work hard one time, and then, I can kind of reap the benefits of that down the road.
Dude, that's beautiful, man. And I think that's the biggest thing. And, I think some people, they can, once they start to see a lot of success, if they don't have a solid base and they forget their why, why they originally got in this space, you get lost in it, man. I mean, I've met guys that have 8-figure net worths, 9-figure net worths that are miserable, man. And I've met guys that have 7, 8-figure net worths that are living the best life. I mean, their work-life balance, they work maybe 2 hours a day, just a couple emails, a couple phone calls, and they're off traveling, hanging out with the kids. It's easy to get lost, man. I think it really is easy to get lost once you hit a certain level. And I really that's why I really enjoy talking with you and Yeadon. The story he tells about that investor who ended up being his father, that got me teary-eyed, man. That's incredible. It's incredible how much power syndication has, and then also how much influence and power you have, and how much change you can make in people's lives. But staying focused, staying centered on your goals, and why you got in, I think that's really important.
Well, you got to be very cognizant of what you want and what's going to make you fulfilled. And I'm very aware of a certain level threshold of busyness, and that once I get above that, I really don't like it. And so I'm not gonna go above that. And with the people out there, like in my Facebook group and in your groups and listening to your podcast, I feel like a lot of them, they're slaves. They're not happy. They're in this job. They're stuck. They're trapped. They've built this life that they have to make $80,000 a year, whatever it is, to put food on the table, pay their mortgage, pay for their kids and their wife and everything else. But yet there's no way out. And that's what I love about the real estate, and I love teaching it, is it's showing people, like, you don't have to be a slave. You don't have to trade your life force for money, because money is just an idea. And if you can capitalize on an idea and put in the action and have the knowledge behind it, you can make as much money as you want without trading any more time than you have to. And the concept of, I'm going to trade a block of 8 hours for $500 or $300 or whatever you're making per day, that's foolish. That's a one resource that we cannot get back. And when you're spending that, your attention is your crown jewel. Whatever you focus on expands. And if you're spending 8-10 hours a day focusing on something that you don't want to be doing, like a job that you don't like, that you're never going to be able to make the kind of money or have the lifestyle that you want or the freedom that you want, like, that's the only thing that's going to expand, is that job, because you're focusing on it so much. And when you start carving off like half an hour a day, like, I'm going to focus on learning multifamily or doing this or taking the steps or cold calling brokers. And then when that grows and grows and grows to the point where you don't need the job anymore, and you can take that leap of faith, then your life really blows up, because now your focus and attention is on your future versus someone else's future, someone else's goals.
And one thing you said, man, money is an idea. That's really powerful, dude. Because it is. Money, it's a tangible object, it's a resource. But when you think about it, how do us humans actually earn money? Think about it. How do we earn money? Either you perform a task for an individual, for another individual, and that top individual pays you for the task, so therefore you provide a little bit of value. Or in our case, we provide a value or a service. We provide housing for a lot of individuals. So money is an idea. Money comes to those who provide value or provide a great idea that provides value. I think my favorite example of like high income earners are musicians, artists. I mean, dude, it might take Lil Wayne, sorry, it might take Lil Wayne maybe 10 minutes to record a song, to actually like say it, and then I don't know how long it takes to edit, put everything together, but a lot less time than it takes a corporate guy to work 12 months and make million. But that song blows up because people like it. It provides them value. They resonate with it. So money is an idea, dude. It's an idea, and it's attracted to those who provide value. So, dude, the amount of value you're providing to people, even though you're probably not charging people what others in your space are charging for the value, it's going to come back to you so much more, and it's going to provide so much more for you, dude. Like,
For sure. And that's why I think you have to think about how can your ideas and what you're doing provide value to the most amount of people possible. And that's where when you look at these businesses, like, in multifamily,